Ever watch a price chart and see the price move up, hit a certain level, and then just fall back down? Or maybe you've seen it drop, hit a point, and then shoot right back up, almost like it's bouncing off an invisible wall. You might have thought to yourself, how did that happen? Is it random? Is it magic? Well, I'm here to tell you it's not magic. It's one of the most fundamental and powerful concepts in all of trading, and it's called support and resistance. If you're new to trading, especially in the Forex market, this is probably the single most important concept you need to master. It's the foundation upon which almost every other trading strategy is built. So, grab a coffee, get comfortable, and let's break this down. In the simplest terms, think of the market like a bouncing ball inside a room. You have a ceiling above you and a floor beneath you. In trading, that ceiling is called resistance. Resistance is a price level where selling pressure is stronger than buying pressure. Imagine the price is climbing higher and higher. As it gets more expensive, more sellers start to think, this is a great price to sell and take my profit, while fewer buyers are willing to chase it. When the sellers overwhelm the buyers, the price stops rising and often falls back down. It's the ouch point where the market collectively decides, nope, that's too expensive for now. So if resistance is the ceiling, what's the floor? You guessed it, that's support. Support is the exact opposite. It's a price level where buying pressure is stronger than selling pressure. Picture the price falling. As it gets cheaper and cheaper, it reaches a point where buyers see a great opportunity. They think, wow, this is a bargain, let's buy. At the same time, sellers who are in the market start to get nervous about selling any lower. When the buyers overwhelm the sellers, the price stops falling and often bounces back up. It's the bargain bin where the market says, this is a good price, let's jump in. So you have resistance, the ceiling, and support, the floor. When you plot these on a chart, you can often see the price bouncing between these two levels, almost like it's trapped in a channel or a range. This is the playground where traders operate. Now, you might be wondering, why does this actually happen? What creates these levels? It all comes down to market psychology and memory. Markets are made up of millions of people making decisions, and people tend to remember significant price points. Let's think about resistance. Say a currency pair like EUR/USD rallied up to 1,1000 and then fell. What happened at that level? A few things. First, traders who bought at a lower price, say 1.0900, saw 1.1000 as a great place to take their profits, so they sold. Second, traders who thought the price was too high decided to open short positions, betting it would fall. Now, if the price drops and then climbs back up to 1.1000 again, what do you think will happen? The traders who missed their chance to sell the first time are now thinking, I'm not making that mistake again, and they'll be ready to sell. Also, the traders who shorted it the first time and made money will see it as another good opportunity. This creates a supply of sellers at that specific level, reinforcing it as resistance. The same logic applies to support. Let's say the price dropped to 1.0800 and then bounced back up. The traders who wanted to buy but hesitated are now kicking themselves. They're thinking, if it ever gets back down to 1.0800, I'm definitely buying this time. Additionally, traders who bought at 1.0800 and saw the price go up will see it as a proven area of value. If the price returns to that level, all these waiting buyers create a huge demand, which provides support and pushes the price up. It's a self-fulfilling prophecy driven by collective human behavior. So how do you, as a trader, find these all-important levels on your charts? It's simpler than you might think. You're essentially looking for historical turning points. Open up any price chart. Let's use EUR/USD on a 4-hour time frame as an example. Look for areas where the price has clearly reversed direction multiple times. To find a resistance level, look for at least 2 or 3 distinct peaks or highs at roughly the same price. Take your drawing tool and draw a horizontal line connecting these peaks. The more times the price has touched this line and turned back down, the stronger and more significant that resistance level is. You're looking for obvious, clear-cut turning points. Similarly, to find a support level, look for at least 2 or 3 distinct troughs or lows around the same price area. Draw a horizontal line connecting these low points. Again, the more bounces off this line, the more reliable that support level is considered. These lines you draw are your visual guide to the market's memory. One important tip: think of support and resistance not as exact razor-thin lines, but more as zones or areas. The price might not reverse at the exact same pip every single time. It might push a little above or dip a little below. That's why it's often better to draw a thin box or a zone to represent these levels. This gives you a little bit of wiggle room and helps you avoid getting faked out by small overshoots. Now, here's where it gets really interesting. Support and resistance levels are not permanent. They can and do break. In fact, a breakout is one of the most powerful signals in trading. But what happens after a level breaks? This is a crucial concept called role reversal. Imagine a strong support level that has held the price up multiple times. Suddenly, a wave of selling pressure hits the market, and the price smashes right through that support. What happens next? That old support level often transforms into a new resistance level. Why? Think about the psychology. All the traders who bought at that support level, expecting it to bounce, are now in a losing position. They are sitting there, hoping for the price to come back up to their entry point so they can get out without a loss. If the price does pull back to that old support line, these trapped traders will rush to sell, creating a wall of selling pressure that now acts as resistance. The same thing happens in reverse with resistance. If the price breaks powerfully through a strong resistance level, that old ceiling now becomes a new floor. The traders who sold at that resistance are now on the wrong side of the market. If the price dips back to test that level, they might buy to close their short positions and cut their losses. At the same time, buyers who missed the initial breakout see this dip as a second chance to get in. This combination of buying pressure turns the old resistance into new support. This principle of role reversal is a game changer because it helps you anticipate future market turning points based on past levels. So let's recap what we've learned. Support is a price floor where buying pressure takes over. Resistance is a price ceiling where selling pressure dominates. These levels are created by market psychology and memory. We find them by looking for multiple historical turning points on our charts. And when these levels break, they often switch roles. Broken support becomes new resistance, and broken resistance becomes new support. Understanding this one concept is like being given a map to the market. It allows you to frame the price action, identify potential entry and exit points, and manage your risk more effectively. Instead of just seeing random wiggles on a chart, you'll start to see a structured battlefield of buyers and sellers. You'll understand why the price stops where it does and where it might be headed next. This isn't a magic bullet that guarantees you'll win every trade, but it's the solid foundation you need to build any successful trading strategy. So, your homework is to open up your charts on any time frame and start practicing. Draw your support and resistance lines. Watch how the price reacts to them. See if you can spot role reversals as they happen. The more you do it, the more intuitive it will become. Thank you so much for watching. I hope this explanation has cleared things up for you. If you found this video helpful, please give it a thumbs up. It really helps the channel. And if you want more trading education just like this, make sure you hit that subscribe button and ring the bell so you do not miss our future videos. Happy trading, and I'll see you in the next one.